Good afternoon, good morning. Welcome to Bank Millennium second quarter / first half 22 results call. With us, we have, as usual, Mr. João Brás Jorge, Chairman of the Management Board, CEO, and also Mr. Fernando Bicho, Deputy Chairman of the Board and our CFO. The format of our meeting or presentation will be similar to the usual one. We'll have a short, roughly half an hour presentation, and a Q&A session will follow. Fernando, the floor is yours.
Thank you. Good afternoon. Thank you for attending this presentation. As usual, we'll guide you through the presentation that we distributed today in the morning. I will start with the first snapshot on pages 5 and 6. It is visible that we continued in the second quarter of the year the trend of improvement of the operational profitability of the bank. This translated into a strong increase of core revenues driven by net interest income that was 67.6% above in the first half of the year versus last year, and almost 23% quarter on quarter. At the same time, costs grew at a slower pace. In fact, if we exclude the contributions to Banking Guarantee Fund and to the Institutional Protection Scheme that we booked in the second quarter, the cost growth was only single digit during the first half of the year, which should be noted in the context of a very high inflation that we have currently in Poland. Also, we continue to benefit from relatively low cost of credit risk. And at the same time, we continued still to strengthen the provisions for FX mortgage legal risk. But it should be said that this second quarter, we would have booked a positive net profit even after the provisions for legal risk for FX mortgage, if not the extraordinary contribution to IPS. Still, we significantly decreased the loss during the first half of the year to half of the value of last year. And if we exclude extraordinary items, in fact, we more than doubled the net result of the bank. On page 6, this financial performance, very positive, was of course also based on a very solid business performance that was translated in continuation of a significant increase in the number of total active customers and total digital customers, especially the last one growing 273,000 versus 1 year ago. Some rebound in deposits from individuals in the second quarter, and loan growth growing 5%, but in fact growing faster if we are at 11% if we would exclude FX mortgage loans. On page 7, we see the main financial highlights. Apart from the NII that I already mentioned, we had the strong growth of the net interest margin by 156 basis points, driven by the significant increase of interest rates. But on the other side, a smaller growth of fee and commission income that grew 3% year on year. As a consequence of these results, we would show, excluding extraordinary items, an adjusted ROE of 23% and an adjusted cost to income of 33% and a cost of risk of 37 basis points over total loans. Now going through the details and starting with page number 8, it is visible this improvement quarter after quarter of the results of the bank. So in fact in the second quarter, the net result without extraordinary items, namely FX mortgage related costs and extraordinary contribution to IPS, the net profit would reach 637 million zlotys, which would be 30% above the level of the first quarter and the double of the same quarter of 1 year ago. It's also, and this despite the fact that we continue to have relatively high cost of provisions for legal risk still booked in the second quarter. On page 9, we see the evolution of operating income driven by net interest income, which is a consequence of the gradual repricing of the loan portfolio due to the increase of the interest rates, which was especially felt in the second quarter of this year. But at the same time, we are also showing a gradual increase in the average cost of the deposits. Obviously, interest rates on the deposits are also going up, but still this allows us to improve the NIM in the second quarter to almost 4.5 percentage points. On the net fee and income line, the performance was worse due to the fact that we have been facing a significant correction in the investment funds market with a decrease of the assets under management due to the significant market correction, both on the fixed income and on the equity side. And as a consequence, the fees from investment products decreased versus 1 year ago, and the growth of other lines such as accounts, services, and other, and cards and loans were not enough to fully offset this negative trend. In terms of cost efficiency, continuation of a clear improvement. The total costs, excluding BFG and IPS, grew just 9% year on year, with staff costs growing 8% and other admin growing 11%. We continue to have a gradual optimization of the branch network and also still some reduction in the overall number of employees. The asset quality remained strong. As you can see on page 11, even the NPL ratio decreased during the quarter to 4.3%, also supported by the sale of NPLs that at the same time generated a significant positive result of 40 million gross in the second quarter. And this allowed the overall cost of risk to stay at a relatively low level of 37 basis points over total loans in the first half of the year, but specifically in the second quarter at 35 basis points over total loans. On page 12, regarding liquidity, stable and solid with a loan-to-deposit ratio of 83%. In terms of capital, still we had a decrease of capital ratios versus the first quarter, and this was driven essentially by two factors. One was the fact that we still booked a net loss in the second quarter due to this extraordinary contribution to IPS. And the second was that we still faced a decrease in the value of the bond portfolio that also partially affected the own funds. And these two elements together with also a small increase in risk-weighted assets, justifies the decrease of the capital ratios in the second quarter of the year. Still, as it is shown, we finished the quarter still with a clear surplus above the minimum required levels. Moving now to the FX mortgage portfolio part. We continued during the second quarter the significant effort to reduce the absolute and relative value of the FX mortgage loan portfolio. This is visible in the overall decrease in currency of total FX mortgage loans by 20% year on year, without deducting the legal risk provisions and a decrease of 5% just in the second quarter. At the same time, we still had continuation of the inflow of court cases at a pace similar to the previous quarter. And this was one of the drivers, if not the major driver, of the continuation of the increase of the provisions for legal risk, which we already announced some days ago, that reached 467 million for the Bank Millennium portfolio, and brought the total accumulated balance sheet value of the provisions to over 3.9 billion zlotys. As a consequence, if we look at the gross FX mortgage portfolio after deduction of the large part of the legal risk provisions that are allocated to active contracts, the share of FX mortgage continues to drop and was close to 10% at the end of June. On page 14, the increase of the provisions that we have done in the second quarter and the reduction of the portfolio contributed to the increase of the ratio of total provisions over outstanding balance of FX mortgage loans, gross balance, and we increased this ratio to 36%. Also important is that the effort of decreasing the portfolio was supported by another successful quarter of negotiations of agreements with customers. We had the 5th consecutive quarter where we managed to sign more than 2,000 amicable agreements with customers, and for the 5th consecutive quarter, this number was higher than the inflow of new court cases. Of course, this came with a cost, which is shown on the bottom right slide, on the bottom right graph of the page 14, which was slightly below the cost of the first quarter 22. Moving to the second part of the presentation regarding business highlights. So the growth of total loans was driven by a strong 19% growth of PLN mortgages year on year, and also a clear rebound in leasing portfolio, growing 8% year on year. Customer deposits growing 7%. Active digital customers already reached 2.4 million, and also a significant increase in debit cards by 202,000. On page 17, we see the split of the growth of the loan portfolio, excluding the FX mortgage. In fact, total loans grew 11% year on year, driven by the growth of PLN mortgage and also a rebound in the overall exposure to companies, including leasing and factoring, while deposits grew 7% year on year, mainly driven by the growth of loans of deposits from companies. The structure of the portfolio continues to show a dilution of the exposure to FX mortgage to levels of around 10%. Finally, we also, of course, as I mentioned, we are facing a decrease in the assets under management due to the significant market correction, which is then translating into lower fees. On page 18, looking at more details from retail portfolio, we had a stronger performance in terms of sales of consumer loans in the second quarter, 26% higher than in the first quarter, and this allowed again to come back to a growth of the consumer loan portfolio. Although still first half of this year versus last year still shows a decline of 7% in terms of origination. In mortgage, also a rebound in the second quarter by 12% versus the previous quarter. Overall, year on year, in the first half of this year, we originated less than 11%, but still a relatively strong number. Also, in terms of retail customer funds, we showed rebound in retail deposits during the second quarter of the year. On page 19, strong growth and steady growth of total number of customers, active customers, already above 2.8 million active customers in retail, growing 66,000 in the second quarter. Also steady growth in the number of active micro-business clients. And also this is translated into a significant increase in the number of current accounts, a growth of more than 130,000 year-on-year, and debit cards, a growth of more than 200,000 year-on-year. Importance of digital channels is clearly shown on page 20 and the next pages. Especially we would focus on the significant number of active mobile users, 2.1 million, and also the share of the digital channels in the sales of cash loans, 78% in the first half of the year, 91% of term deposits, and 32% of the share in acquisition of current accounts. And also this is translated into significant increase in the number of current accounts that were opened online by 51% versus the first half of 21. So all the numbers show a significant increase from a very high level already of the digitalization of our customer base. Page 21, we also illustrate that our digital channels are providing access to additional non-banking services, as can be seen by the administration in a smart phone, and also top-up codes that also have raised a lot of interest from our customer base. And additionally, page 22, the permanent investment of the bank in terms of improving its digital accessibility, this time is illustrated by the redesign of the process of opening an account online and in the mobile app, including with logging into another bank, and also with the new selfie process. And on page 23, the digital channels are also supporting Ukrainian citizens in terms of charity transfers, communication, access to e-administration, and also including the application for 500 plus. Goody continues its development. We update the numbers on page 24 with 221,000 downloads of the app just in the first half of 2022. On page 25, on the company's side, a rebound in lending activity with a growth of 5% of gross loans year on year, especially supported by factoring and leasing, and also a very solid growth of total deposits and a general increase in the transactional activity of our customers, translated into cash turnover, domestic transfers, and also, as we can see on page 26, a significant increase in the number of, on the volume of FX transactions. The leasing sales were almost at the same level as 1 year ago, but already contributed to a clear growth of the portfolio, and also factoring already growing. Importance of digital channels for business, we are this time illustrating on page 27 with significant effort also regarding our small business clients, and this is translated already into a growth of 60% in the number of business accounts opened online in the first half of this year versus the previous semester, and in the growth of 40% in the value of cash loans for micro entrepreneurs, also comparing with the second half of 2021. And now moving to the last part of the presentation regarding credit holidays and capital management. So I think all of you are aware about the legislation that was recently published regarding credit holidays. We have announced the expected impact through a current report on the 15th of July. At that time, we announced that if 100% of the borrowers would apply for such holidays, the total cost for the group could reach 1.8 billion zlotys. The upfront cost will be booked in the third quarter based on an expected participation rate in a range between 75 to 90% of that amount. So this is the range where we expect to have the final booking of the cost during the third quarter. The credit holidays usage does not trigger a classification of the loans, already anticipating a question that could come. And regarding impacts, so on page 30, just as a reminder. So, again, we made these calculations assuming final booking in the range between 75 to 90% of the overall potential maximum cost. This would imply a decrease of capital ratios by around 300 basis points, and this means that our Tier 1 ratio may fall between 118 to 174 basis points below the current minimum requirements set by KNF. And so, as a consequence of the risk of breaching the minimum capital ratios, we took the decision to launch the recovery plan. Just to remind, the recovery plan is one of the documents that every bank needs to have approved and is updated once a year. Our last update that was filed last year was approved by the regulator in February this year. And as we disclosed in our current report and again repeated today in our financial report, we intend to increase the capital ratios comfortably above the minimum required levels through a combination of further improvement of operational profitability, which has been demonstrated in recent quarters, and also capital optimization initiatives, such as the management of the risk-weighted assets, in particular through loan securitizations. Of course, also during the period of the recovery plan, we will not be paying the banking tax, and this is the way we expect, in a timely manner, to recover from the negative impact generated by the upfront booking of the expected cost of the credit holidays. So these are the main points of our recent performance and also some further developments. And now we are available for questions. Thank you.